Hello, it's Patrick Dwyer and Greg Pool here again from Aligned Wealth, and we are here in Miami meeting with KKR Private Equity with Alisa Wood. Very excited today. So, private equity basically is one of those topics where the questions people have in private are very different than what gets discussed in public. Too much money, chasing too few deals, exits are slowing down. Is it still worth the illiquidity? Today, we're going to answer those questions directly, and we have the right person to do it.
Yeah, Alisa Wood, welcome. Alisa is a partner at KKR, one of the original private equity firms. It's still one of the most respected in the world. Welcome. Really glad to have you here.
Thank you so much for having me. It's great to be with you, and I'm excited to talk about a lot of what we're seeing in the industry today.
Yeah, we are too. And we've broken the conversation down into two parts. First, we want to do a little myth busting, address some of the skepticism that's been building around private equity as an asset class. Certainly, the public stocks are down a lot this month. Then we'll get into KKR's specific approach, how you source business, how you look for it, how you exit. Does that sound good?
That sounds great.
Yeah, so why don't we start on the myth busting piece?
Yes. Let's start with that. Let's start with the myth busting piece. So that's the capital question. There's a narrative out there that private equity has gotten too big. There's too much money chasing too few quality opportunities. Industry dry powder levels at record highs. Is that concern a legitimate concern? How does that impact KKR's ability to deploy capital at attractive terms?
I get this question, probably 5 times a day, and I think it's so important to just understand the math of it and understand the data piece of this. While I hear that this is a common concern and clearly one that I think if you read the headlines in any of the major papers, it's probably what you'd see. It's actually probably the furthest from the truth when you take a step back and actually think through and look at the data around it. Now, what does that actually mean? I would say a few things. One, as an industry, the private equity opportunity set, it's massive. It's really large. And by the way, it's not stagnating. It's continuing to grow. And it's growing for a lot of reasons. One, companies are getting larger. So think about it from this perspective. If you look at it in the last 20 to 25 years, the average company in the world has grown many times over. Okay, and that's taking out the Mag 7. So when you actually look at just the average size of companies around the world, they're much larger than they've ever been before, and it's not going in the opposite direction. Now, the other thing that's really important, and you got to think about this in the context of buying companies, hopefully good ones you can make great, is that it takes more equity than ever before, right? This is not 1985 anymore. So when you think about how much equity you need to buy one of these companies, on average, we're equitizing our deals somewhere between, call it 60, 65%. They're highly equitized, right? So at the end of the day, not only are companies larger, but you also need more equity than you ever did. So if you think back to even the 90s when I started in the business, the amount of equity needed is probably somewhere grown between 2 to 3-fold. That's massive. And then the third point, and I think this is probably of the three, it's probably one of the most interesting, is that more companies are staying private or going private. Now, why is that and what are we seeing? The average company is actually staying private or I would say not going public, probably 2 to 3 times, if not even 4 times longer than it did 20 years ago. And the reason for that is if you are a public company, okay, the factors that drive your stock is not just bottom line performance. Okay, the factors that drive your stock in a lot of cases are market dynamics. It's about, do analysts cover you the right way? Are you in a sector that's interesting and exciting that people want to actually hold? And then at the end of the day, you're going to be managing to quarterly earnings, not necessarily managing to the bottom line growth of the company. Does that mean staying private is for everybody? Of course not, right? For the right company, being public makes a lot of sense, but for the wrong business, it doesn't. And I think what's been so important is when you think about this universe of private companies, the market is alive and well today to help support them. And that's fundamentally what's different. So if you think about this, just to put some numbers behind this, in the last 20 to 25 years, there's about 50% fewer public companies today. Okay, that's vastly different. In addition to that, if you look at companies with 100 million more revenue, Okay, we're looking at somewhere in the neighborhood of 80 to 90% of those actually being private. So if you are only investing in public equities, you're not touching that whole part of the market. So now what does that mean in terms of your question? I just threw a lot of data at you. How do you make sense of that? How do you find the signal and all that noise? The reality of it is I think very, very simple, right? Dry powder, it's completely misinterpreted. And when you think about the absolute levels of how much capital there is in the world to invest, yes, it is high. For sure, it is high. But if you look at the places and the homes it has to go, it's wider and broader than ever before. And if you want to look at one other interesting data point, the ratio of dry powder to unrealized asset. This is something that I feel like no one actually talks about, which I find fascinating. Dry powder to unrealized asset value today is roughly about 40%. This is at the low end, probably almost the lowest end in the last 2 decades. And if you think about the peaks over the last 2 decades, that number was more like 70 to 90%, which I would argue suggests that capital availability today is actually reasonably balanced with regard to the broader opportunity set. So I know I threw a lot of data at you, but I think that just hopefully helps reframe some of those myths in the market and where is the actual reality in all of that.
The very interesting. I mean,
Yeah.
especially the 80 to 90% over 100 million are private. That's incredible.
Yeah. I mean, that's
Massive.
that feeds a little, I think, into our next question, which is kind of public versus private, and why private. All our listeners know Pat and I are huge fans of the public equity markets, and we think it's a really high bogey to outperform. Strong numbers, a lot of positive headlines, people have a lot of gains. So a lot of our clients say, why do I need private equity at all? What's the case for PE in a portfolio today? Some of it you just addressed, and that there's a lot of companies you can't get access to in the public markets. But maybe frame that for us, and why does the long-term lens matter so much in this particular asset class?
Absolutely. So I think a lot of what we just talked about obviously applies here, but let's actually just look at what's happened in the public markets for a minute. Right. So if you look at over the past 3 to 4 years, the S&P, we all know this, has compounded at more than 20% annually. And if you look at the data, we're clearly very data driven by a lot of my comments. If you look at the data, when you look at periods where the S&P has been compounding at 20% or more over a 3-year period, the next, call it 3 to 4 year window, typically shows that those returns sharply fall off. And that usually happens, over that next period of time. And if you want to look even more specifically, over the next 5 years, we really think that that will look more like 5% annually, not the 20. Right. So what I like to often say is like, what got you here is probably not going to get you to wherever you want to go. So the significant portion of public market returns, if you think about that exuberance, it's really been pulled forward, right? You see that, you'll probably see that in your asset allocation. If we're sitting here 5 years from today, you can tell me if I'm right or not. But what I think about private equity and the importance of that in the context of the overall your overall asset allocation is that private equity acts as that patient capital. And it's designed not to capture short-term market momentum, right? It's the opposite of that. It's all about the longer term horizon and how do you buy good companies, make them great, drive value creation through active ownership, and really make sure that the return that you're generating is going to be what you do with the business, not financial engineering, not buy low, sell high, none of that. Right. So, what does that mean? It means that hands on operational improvement, at least in our perspective, is the name of the game. It's about how do you drive earnings growth? How do you expand margins? How do you reposition a business strategically? How do you top grade talent? Do you have the right management team in place? And if you could do those things, what should happen is you should be able to compound at a very nice, healthy clip over a long period of time. And that's what generates your returns. Now, all of that sounds great, right? And I think we probably all would agree. Why is it so hard? It's hard because of one thing that I think is the most misunderstood thing in the market. It is all about manager selection. It's the who, it's not the what, right? So when you think about private equity, There are thousands of private equity funds in the US alone. I joke that recently you might have heard this stat. I said this at a Bloomberg conference and I became a meme. My daughter was joking that she was seeing me on social media, which is having a 14-year-old daughter is never actually a good thing. But the stat that I gave was there are more private equity funds in the US than there are McDonald's. Okay, so if that's true, which it is, how do you actually find the right manager? And by the way, does it actually matter? And the answer is it does. So if you look at the dispersion of return in private equity, it's wider than ever any other asset class. And by the way, it's wider today than it ever has been in our history. So the average return dispersion between best-in-class managers and less performing managers, call it bottom quartile, it's about 1,400 basis points of return dispersion. If you look at that return dispersion in public equities, or if you look at that return dispersion in fixed income, it's 200 to 300 basis points. So what does that tell you? It tells you that if you're not investing with the best-in-class managers who, or we like to say, make your own luck and control their own destiny and how they create value, you're actually better off not investing in private equity, which I know is not a popular thing to say, but I think that's important. And the last point I would make is that you really need to think about one, diversification, and two, correlations. And what do I mean by both of those? Obviously, you can underwrite a great business and think about how you're going to transform that business over the cycle. And that's a lot of what we do, right? We're not looking for the moment in time pops. We're looking for that long-term growth, which is great. But what you really need to make sure you're doing is having a very diversified approach, right? In terms of what industries are you investing behind? What themes are you investing behind? Where in the world are you putting your capital? The world is asynchronous. And you need to make sure, however you're approaching private equity, best managers taking that long dated approach, but you're also making sure that you're thinking about risk in the right way, right? This is one where risk is not bad. If it's ring fenced, if it's understood, if it's priced, you actually can do some pretty interesting things in the way the world is right now, being extremely complex and volatile. You can actually sort your way through that. And then the last piece is, and I think this is another important point, when you think about so much of how we think, and hopefully you're hearing me say this, is we think about everything from a risk perspective, right? What's the trade-off at any given moment in time? So if you think about the correlations between stocks and bonds, okay, they used to be, when you think about bonds in particular, they were seen as this shock absorber when stocks were going down. Today, that correlation is totally reversed. Things that were uncorrelated are highly correlated. So what's really important at the end of the day, at least from our perspective, is private equity could actually act as some of that shock absorber if it's done the right way. Diversified, high manager selection, all of that. Now, why is that? It's because private equity should be creating a less correlated return stream, especially in those moments of volatility. So that was a lot I threw at you, but I'll pause there.
Private equity stocks are surely exhibiting a lot of volatility right now. So like the recent headlines, and by the way, we agree with, we believe that there is opportunities in, to get alpha in private equity. We don't believe that exists in public equity markets. We index the public equity markets, and the index returns have been amazing. And we also agree that large cap stocks are expensive, and we've allocated more to other indexes. But recently, one of the things on our clients' minds, and on my mind as someone who has a lot of money allocated to all privates, it's been a really big slowdown in exits and liquidity and IPOs. And pretty much everybody we know is sitting around going, hey, like, when am I getting money back? Can you help us understand, like, what's going on with exits, why it matters so much, and just sort of KKR's view? What's KKR doing? Love to hear that.
Well, absolutely. And this is a topic, if I had to say, our most frequently asked question, this is it. You hit the nail on the head on this one. When you think about what's gone on, I would love to just quote some industry data for a second to level set on actually what the math is, right? If you read the headlines, you pick up the Wall Street Journal, the FT, or whatever paper you read, you would literally think exits have fallen off a cliff, no one's getting money back, realizations are dead, right? That's actually not what's happened. And so if you look at the last 10 years of data, and this isn't my data, this is Cambridge data, right? So I take no responsibility for it other than quoting it. But if you look at the last 10 years of data, the highest year in terms of realizations was actually 2021. Okay, that shouldn't be surprising, right? When we saw a lot of the run up in that year. The second highest year, and these 2 years are actually, I think, officially 25 surpassed 24. So 25 in the last 10 years was the second highest year for realizations, and 24 was the third. So if you read the headlines, I don't think anyone would believe any of what I just said. Now,
I agree with you.
okay, so but here's the kicker. Here's why, by the way. It's because it's a denominator issue, not a numerator issue. Now, what do I mean by that? What is DPI? Right? It's distributions to paid in capital. The distributions are doing exactly what they should be doing. Okay. Now, by the way, not all managers are created equal. We should asterisk that and come back to that for a second, because there's a lot in terms of where are realizations actually coming from. They're not coming from maybe some of the traditional sources of realizations, and we can talk about why. But the issue is that in 21 and in the first half of 22, there was a huge overdeployment curve, which meant that you pulled forward several years of deployment that shouldn't have happened. So if you actually ascribe to linear pacing, which we do, I think you know that, we're big believers. You can't pick markets. You can't time when to invest. The minute you think it's a good time, it's too late. The minute you think it's a bad time, you're too far in, right? We've all done this for too long. But what we believe is you just consistently deploy every year. Okay, take that risk out of the equation. Buy good, make great. But what happened was the industry didn't do that. And so when you pull forward that much and that's what's going into the denominator, it looks like it's all out of whack. Now, if the average hold period in the industry, all the data that I've seen it says about 5 years. Now, I might argue that I think that's going up. It's not going down. I think if we sit here a few years from today, the average hold period may be 6 or 7. But all of that being said, it means that those investments that were bought in 21 and 22 shouldn't be up to be realized until the soonest this year. So it's foolhardy to believe that they would even be in the numerator, right? Because they're not ready for that exit yet. Now, so that's the data. Okay, take a look at that. Now, what's actually happening in practice? The realizations that are clearing the market are typically more in the sale category, not in the IPO category. IPOs are alive and well. For the right business, you could still take it public. We have no issue with that. But where we have seen the data, at least in our data, 70 to 80% of our realizations typically sit in some type of sale to a strategic. Okay, a large corporate, sale to a family, sale to a sponsor. That's come way down, but like in general, that's another option. But only about 30% of our exits are coming from IPOs. So what it means is, aside from the whole numerator denominator issue, if you're reliant on taking a company public, you may have a problem if you don't have the right business and the right theme in the right piece of the world. Right. So for us, it's all about, you got to think about, how do you buy a company that has multiple ways to win and has multiple exits? Can you think about a company going public at the exact same time that you're spending time with the strategics that may want to own it? When we buy a business, we outline exactly who those potential owners could be. And we use the next 5, 6, 7 years to actually build relationships with those folks so that we can make sure we're in a good place when we get to the end. We learned one really important thing. Well, we've learned a lot of really important things over the last 50 years, but one in regard to this. When we get to about 80% of our value creation, we look to exit. Okay, we don't wait, because that last tail is often what kills you. Okay, the black swan event comes along, markets turn, a competitor that you didn't worry about all of a sudden now is actually going to eat your lunch and you didn't even see it coming. Don't be greedy.
We would agree with that, as having been a professional investor for a lot of years. I've learned that lesson as well. I mean, you touched on a lot of these things, so I think I know some of the answers. But private equity goes through cycles, right? And you have rate cycles and credit cycles, exit cycles, and some managers do well in one environment but not another. I guess in your experience, and you've talked about some of this already, risk management, maybe deployment cadence, but what are the qualities or disciplines that you think separates the managers who perform consistently across the cycles from the rest?
I think at the end of the day, you need a manager. You need a manager who, one, has a proven developed strategy. Okay, who knows how, is very clear about how they buy, what they do, how they do it, what are the resources that they use to generate those returns. We've all been in this business a really long time, right? And investing, at least in our view, it's all about pattern recognition, right? How do you find the pattern and how do you repeat the pattern? And if you can create a process around that pattern, that's where you actually take risk out of the equation. So, what is it that we think is really important? One, we think you need to own your resources and not necessarily rent them, right? So, one of the things that we've built out over the last several decades is having resources in all of the areas that we think are differentiators. In terms of how we drive, and I used this phrase before, make our own luck, right? How do we do that in a very repeatable way? Operational resources. These are folks who focus on lean manufacturing and Six Sigma and procurement and supply chain management. Like, at the end of the day, these are not consultants who write big reports, right? These are people who show up on your factory floor, teach best in class practices, and move on to the next one. Meaning all of ours. That's the next one, the next company of ours. How do we make sure that we have the right risk framework in place? We have folks who analyze macro risk, geopolitical risk, currency risk. All of those things matter, right? And we've added dozens of resources over the years for that. Make sure that you're deep in industry. You have to know your business better than anybody. We're not competing with another GP typically. We're competing with the strategic. That's who our competitors are, right? What do we like to buy? We like to buy complexity. In our value creation, we create simple growers. Why do strategics typically like to buy the companies we own? Because they want to own simplicity. Okay, they want to buy something where all the heavy lifting's been done already. We've taken the complexity out of it. Okay, so you need the resources to be able to do all of that. And the last piece I would say, and this has been more important probably in the last 10 years than it ever has been before, is having capital markets resources, right? So when you think about the trade issues sitting here last year on April 2nd, okay? We were, hours away, days away from signing a deal. Banks went risk off. Okay, we literally had no financing. Our purchase price on that pipeline of opportunities reflected the complexity and uncertainty of the market. The more complex the markets are, the better time it is to buy. It's hard, you got to have conviction, but it's actually those lead to better returns typically. So the fact that we were able to have an entire team that could go place that ourselves, that was the difference between being out of the market for 2 months and not, right? And if you look at the number of opportunities, the number of companies we bought over that that 2-month period, we bought about 2 handfuls of investments, right? So I think the important part is, one, making sure that you've got resources. 2, you need to be cycle tested. Okay, this is a world where, the fact that we could sit here and say it looks more like X and less like Y, right? It gives you confidence in these moments when everyone else is running out to run in. And I think that cycle tested nature is the most important part of the buying your own luck piece of it. And then the final piece is, we say this all the time here, you got to control what you can control, right? And if you can do that well, and make sure, and we talked about some of these issues already, you control deployment. If you can linearly deploy, that sets you off from a portfolio alpha standpoint in a very different way. You can control the operations of your business. You can control your management. Well, guess what? That leads to asset alpha. Portfolio alpha and asset alpha are the most two important things that you can really lean into in this type of moment when you can't rely on beta. And by the way, the best managers wouldn't be relying on beta. Nothing wrong with beta, right? But it's just the unpredictable, right? So if you can, what does this all mean? Scale matters. Being consistent, robust, disciplined in your deal flow, in your ability to execute, in your ability to diversify, in your ability to avoid certain risks, lean into other risks because you understand what those are. What that means at the end of the day is you should have very outsized performance if it's executed the way we just said.
Well, but what you talked about like, adding operational excellence teams to like really pump up these businesses, because this is a different private equity market than 20 years ago. It's not about leverage, and it's more about making the business better, improving it and selling it and bringing that. And that's why people agree to do a deal with you. So tell us, like, give us an example of like what looks like a potential acquisition, sort of what's your ideal acquisition, like how do you guys think about like investing in trends and so forth, like what's the framework for how you're looking at deals?
It's a great question. It's actually one we love to talk about as deal folks who focus on executing opportunities to invest. I would say right now there are a couple trends, right? I would say one is on the types of deals, and then the other is maybe some of the thematics that we're seeing. So if you would oblige me, I would love to cover both. On the types of deals, this is all about complexity. Okay, there is value in complexity. Now, I'm not sitting here saying we're distressed investors or we're turnaround. That's not what I'm talking about. That's not the complexity I'm talking about. I'm talking about complexity of public to privates, complexity of corporate carve-outs. These are really, really hard deals to do. So what we're seeing more of today, honestly, are these public to privates. The more volatility that you see in the public markets, the more activist investors, right, all over the world. What that's causing is fewer companies wanting to stay public. Now, nothing wrong with being public. For the right company at the right time, being public makes a lot of sense. But if you are, for instance, a mid-sized industrial company, okay, do you think analysts are covering you? Do you actually think you're getting the right coverage in the market? No, there's nothing that, if you're talking about pumps and valves, that's not AI. That's not any of that, right? Now, you might argue that that's a good thing today, but I think that's something that has been a challenge. So if you look at where we've leaned in, find these small to mid-size unloved public companies that are fantastic businesses, where you can maybe use them as a core part of a consolidation play in an industry, and you can roll up and buy other competitors, or you can actually just help them reposition their business, which often you can't do if you're a public company in the public limelight. So if you look at the last, I think it's like 2.5 years, 3 years, we probably have done more public to privates, over 25 public to privates all over the world. Okay, Japan, UK, Germany, Sweden, like pick your country, you got it all a little bit. They're really hard to do. Every market is different. But if you can do them, I think they're great opportunities there. Second, and these are probably the hardest deals of all to do, and I would actually say there's probably only a handful of GPs in the entire private equity market that actually can do them. It's buying non-core assets out of large conglomerates. One of the biggest themes that we're seeing in the market is this capital heavy model to capital light models. Okay, so what does that mean? It means that we've come from a world of benign globalization, and we're now in a world of, honestly, competition, great power competition. And so being the large conglomerate doesn't actually serve you well in terms of a trading price anymore. Okay, so what that means is you've got to sell off your assets that are not driving your growth and are not core to your business, so you could be in a position to reposition that capital and actually invest in the parts of the business that matter. Now, because something is not core, does not mean at the end of the day, it's not good and it's not important. Right. So I use this example all the time. If you look at a company, we bought Simon & Schuster out of Paramount, okay? Um, they made up a couple percent of Paramount's profits. Literally like low single digits. It's a very sizable company. It's one of the largest independent book publishers in the world. Talk about relevant. It's hugely relevant. It just wasn't going to be a needle mover. So when I look at that at the end of the day, and I think what's so important is you've got to find the businesses where you can do something with them. You can take them out and you can stand them up as their own company. You can upgrade talent. If you're a non-core asset, you typically don't have best-in-class management talent. You typically don't have best-in-class practices. You typically you've been underinvested in. But what makes these companies so hard to do and these transactions so hard to do, it's that the day you close the deal, you lose all corporate overhead. You can't issue payroll. You have no health insurance. You have no IT systems. You have no CRM. Sometimes you lose your corporate office. So the fact that if you could have resources that, by the way, stand these companies up, right, time and time and time again, right, it's the same playbook. It's the same pattern recognition. And I think that's where you can have a lot of value in what you do. So those are some of the types of businesses that we're leaning into. We just completed our 70th corporate carve out, which I think is pretty interesting. Now in themes, one of the themes I just mentioned, this capital heavy to capital light model. This other theme that we've been investing behind has been security of everything. When you think about data and AI, owning the data is key. Protecting the data is key. Can you do that the right way? How about I'm going to use some really, boring topics for a minute too, right? Health and wellness, right? When you think about aging demographics, how do you lean into that? When you think about people having children much later in life, what are the impacts of that? These are all themes we've invested behind. Automation, digitization, right? Think about audiobooks. Think about automation in food production. Not something you want to talk about over lunch, but protein processing in dairies and things of that nature. We like, and I think this is the fundamental thing. Hopefully you hear this in all that we're saying today. We like the businesses that you can't live without, that you don't even know you use. Right? The vast majority of companies we buy, you will have to Google the logo and Google the name of. Okay? That's pretty exciting.
Yeah, but you need them. Well, this has been fantastic. We really appreciate your knowledge, your enthusiasm, and you give a really fair picture of why private equity and why KKR.
Yes, thank you very much, Alisa. That was really, really good.
Great to be with both of you. Thank you so much. I appreciate it.